Hello, my name's Mark Blythe. I'm the director of the Rhodes Centre for International Economics and Finance at Brown University. Today on the podcast, we have Professor Stephanie Kelton. Stephanie has written a book entitled The Deficit Myth, Modern Monetary Theory and the Birth of the People's Economy, which has hit everyone's bestseller list and personal reading list and summer reading list over the course of the past few months. MMT is a controversial theory in some quarters, but what it basically does is say, look, this is how the plumbing of the financial system really works. This is how basically governments really finance themselves. And once you realize that, the possibility space for what you think we can afford and can't afford really changes drastically. It was a real pleasure to have Stephanie on the podcast to come in and talk about her new book. Hello, Stephanie.
Hi, Mark. How are you?
Great. It's great to have you here. And the book is doing extremely well, and it should be, because basically it's doing a great public service and turning over some ridiculous shibboleths which have held back public policy and thinking about what we should do with the economy for, I don't know, as long as I've been around. Now, one of the lovely things about the book is you open it up with a personal experience story of how when you first encountered the ideas of modern monetary theory, you thought, that can't be right. And then you spent a year basically trying to prove that that can't be right. And then eventually you said, actually, you know what, this is right. And and I think part of the resistance to this amongst many people, even people who are sympathetic, is in a sense, it's so counterintuitive. And at the same time, it's so simple once you follow it through that you're left in a kind of moment where you go like, hang on, that means everything that I kind of thought for 30 years is backwards. And that's a big pill for people to swallow. So what I'd love to do is just start at the beginnings of this, run through it, right? Just lay it out for people so they've got a one-stop shopping on what this is. And then we'll just chat from there. So let's start with this one. I've criticized this many times before. You start with it. It's a great place to start. Government is not like a household, no matter how many times they tell you it is. Why isn't it, and why is that important?
Well, okay, I guess the simplest, clearest way to distinguish the federal government and its budget from a household budget is to say that one of us is the issuer of the currency and the other is the user of the currency. And we've always kind of drawn a hard line in the sand there because it makes it so easy to delineate what makes the federal government different from a household or a private business or a state or local government, right? I mean, all over this country, you know as well as I do, we got governors who are pleading with Congress and the federal government to send aid, get them money. Their budgets are blowing up, they're hemorrhaging tax revenue, and they can't cover the cost of essential services. They can't keep public sector workers on payroll. They don't have the money to do it. Why are they asking the federal government? Because that's where the money comes from. So it's just that really clear distinction between who issues the currency and who's got to go out and get it from somewhere in order to be able to spend it. And why does it matter? Yeah, you asked, why does it matter? So it matters because, well, for one thing, it helps us to reset our thinking when we think about the government's fiscal capacities, the federal government's fiscal capacities. In the book, you know, I remind readers that in the wake of the financial crisis, and we were in the grips of the Great Recession, and President Obama, you know, he went before the nation. He goes on national television. He's on, with some journalist who asks him at what point the U.S. is going to run out of money. Now, we were just beginning to fight back and claw our way out of the Great Recession, and his response was, "We're out of money now." You know, he said we're out of money now. So the reason I think it matters is that we have to disabuse ourselves of this idea that the federal government can go broke, that our fiscal capacity to respond in moments of crisis is limited by what's happening to the federal budget outcome, that the deficit itself can prevent us from taking further action when we need to, and probably 1,000 other reasons why it matters.
But that's the core one. So just to be very clear on this so people can follow along, right? Everybody who is not a specialist in this, and most specialists, start from the assumption that the government has no money, right? As Mrs. Thatcher used to call it, other people's money, right? So they have to go take other people's money. And this leads to a whole host of things we can talk about, like crowding out, etc. And your point is, that's not what happens. It's just simply not what happens. What happens is the government spends, and then it backfills, if you will, through taxes. And it doesn't even really need to do this so long as there's no inflation in the system. That's right, isn't it?
Yeah, I mean, I think it's getting easier for people to see it because, last year, 2019, right, here in the US, we watched a very crowded field of Democratic presidential hopefuls. And, the policy platforms ranged in terms of how ambitious they wanted to be with new spending or enhanced spending on existing programs, canceling student loan debt, doing Medicare for all, free college, whatever it was. Some people wanted to do a lot, big Green New Deal, and some people wanted to do fairly modest things. But across the board, the question facing every one of those candidates was, how are we going to pay for it? Where is the money going to come from to do these things? So we had an entire year where that question dogged candidates at every turn. It was about, how do you pay for it? And then, fast forward the clock just a few months and March rolls around and all of a sudden Congress is flicking out $1 trillion spending bills, passing legislation left and right. Nobody said, how are we going to pay for it? Nobody's taxes had to go up. So what I'm saying is I think it's a really interesting moment of clarity where people can look at Congress, they can recognize what you just said, which is that they can spend without going out and collecting up dollars from anyone in advance of spending. And once they spend, I've been saying that their spending essentially gives birth to new money. It creates, the spending itself creates the dollars that are then available to the rest of us to hold and to have, and they can travel around the economy and help support employment and aggregate demand until such time as they're taken out, and only the government can remove them. And so I've been saying, think of the IRS as the graveyard for the dollar. So when you pay your taxes, that's the end. They're extinguished, right? So that's sort of the life cycle of how I think of public money.
Right. And so a very intuitive one for people to get into then perhaps is the following. So the nightmare thing that is always pulled out is the printing press, right? So they're running amok with the printing press. Well, as you point out in the book, Bernanke basically disabuses of this notion by saying, no, we didn't do that. We just basically electronically added an absolute ton of zeros to the bank accounts of the big banks, right? So this is how this is actually done. If somebody hasn't really been through this material before or really encountered MMT, the first one, right, government spends and then worries about it. Okay, but I know there are these things out there called like a bond market, and governments either tax or they borrow, right? And you very quickly in the book go, actually, that's not really how it works. So if you could just walk us through that, that'd be great.
Sure. So you're exactly right. So we have this idea that the government has to go out and find money in order to spend. And the two primary sources of revenue to the government are taxes. And then if they come up short, if they want to spend more than they collect in taxes, then they must borrow. And it's an imperative, right? They're required to borrow to cover the shortfall. So the borrowing piece then tells people, students and others, right, that there is, think of a stockpile of dollars that exists somewhere in the world. And there are only so many of them, and they've been placed there by savers. So there are people who are willing to not spend all of their income and to make their savings available to others to be loaned out. So this is loanable funds, right? And that there's competition for those dollars, and the government is one competitor. So the government is in competition with other borrowers for that finite supply of dollars that exists parked somewhere in the world. The more the government wants to borrow, the more it has to compete with others for that limited supply. And that then, if the government is running bigger and bigger deficits, it needs to borrow more and more dollars, leaving behind fewer dollars for private sector use. And so the argument goes that the government, by running bigger deficits, leads to a diminution of the available supply of dollars, and that with reduced supply, the price of dollars goes up, so interest rates rise, and that the rise in interest rate discourages some private borrowers from borrowing money and spending on presumably more efficient kinds of investments, making more efficient. And that this then leads to, in the long run, a slower growing, less dynamic economy because the government gobbled up some of those dollars that would have otherwise gone to more productive private use and made investments. So why is that wrong? So in the book, I just do it, I tell it like a series of dominoes because it's an unfolding sequence of stories, right? If the government has to borrow to finance a deficit, then it will intensify competition for savings. If it intensifies competition for savings, then it will drive up interest rates. If interest rates go up, then businesses don't have enough access to dollars to finance private investment. And if that happens, then you get a slower growing economy. So I just knock all of those down. And one of the ways is, you mentioned that if a private business wants to borrow, it can walk into a bank and ask for a loan. And the bank can do this thing called create a deposit for the borrower. It isn't looking for an available stockpile of dollars. It has the capacity to create bank deposits, right? So even if the government is gobbling up dollars, which it isn't, private businesses still have access to credit. Banks can still extend credit to private lenders, right? The other point, and I think more important one, is that the government's own deficit spending does not gobble up the supply of dollars in existence. It augments them. So if the government spends $100 into the economy and only taxes $90 back out, it has placed a deposit of $10 somewhere in the economy. Its deficit results in an addition, and it augments private savings and wealth somewhere. Those dollars are then available to purchase the bonds.
So in that world then, rather than the deficits being this terrible source of weakness, they become a strength, because what you're doing is basically giving the private sector the corresponding surplus.
Exactly correct. The deficit, the counterpart to the government deficit, is a financial surplus on the other side of the ledger.
Now, why is it, do you think, that we only ever talk about the deficit side? We never talk about the corresponding surplus. Because a key point of MMT, stock flow consistent modeling, to use the technical jargon, right, is that everything sums to zero. You can't just look at the deficit. So why is it we only look at the deficit? Why are we not looking at the other side?
I mean, habit, indoctrination, I don't know how to answer the question, but you're absolutely right. You pick up the Wall Street Journal and the headline across the front page will scream, $1 trillion deficits, the new norm. It could just as easily read, $1 trillion surpluses, the new norm, right? It's just a matter of whose perspective do you want to report this information. And of course, you know, everybody who pays attention in the Beltway and all of the discourse around the federal government's budget, they're always communicating with the public about what's happening on the government's balance sheet, never with, you know, respect to what's happening on the non-government's books. And so, you know, it's just a choice. The CBO could rewrite every report. I wish they would, replacing the word deficit with the words non-government surplus. Every single place you see that word, just replace it. And you could do the same thing for the so-called national debt. You could replace it with a different word. You just said savings.
Yeah, right? Stock of national savings. It's the national savings clock.
Part of the U.S. money, the interest-bearing part of the U.S. money supply. I mean, we could call it anything we want and reduce a lot of anxiety, I think.
Great. So let's continue on to this then, because people can be following our conversations so far, and they'll basically get, all right, so you spend, and the limit is ultimately an inflation limit. We are basically not really taxing and spending. That's wrong. We do it the other way around. Okay, I got you on that one. The crowding out whole thing, that doesn't seem to really work either, because there's no fixed stock of dollars. There's always a surplus somewhere else in the system. I'm with you. But this whole thing about the national debt, right? I mean, the national debt is a debt. We need to pay it back. And also, what about the interest on the debt? That's the one that people always focus on, is if there's a spike in interest rates, then we'll be spending trillions on interest and there'll be no money for anything left. You have a good response to that one too, which is?
Well, a couple of responses. First, I think of this thing we call the national debt itself. You know, the title of the chapter on the debt is the national debt, parentheses, that isn't. So I really think it's a mistake to refer to it that way. I think of it as part of the net money supply. And there is nothing, when you think about it that way, there's nothing to pay back. You've already financed the spending, right? You've just replaced a portion of the dollars that came from deficit spending with interest-bearing currency. That's it. It's just shifting accounts at the Federal Reserve. It's either in a reserve account or it's in a securities account at the Fed. And paying it off just shifts those dollars from the securities account back to the reserve account. So the other part of your question is about the interest on the debt. Yeah. And I can say, man, Mark, you don't have to have worked in Congress in order to understand how big an issue this is. But I did, and I got a real taste of it working in the U.S. Senate for a period of time. This line item in the budget makes them crazy. Both sides of the aisle, absolutely crazy, because they look at, first of all, they look at the budget like a household budget,
Right.
and they think that they've got a fixed pie to work with. And if one line item in the budget starts to get more expensive, right, if it's going to cost more to
Someone
do
else
this,
has to go down.
then exactly. It's like if my cable bill goes up and I'm spending all of my money already, I go, well, where am I going to, what am I going to cut in order to make room for the rising, cost of my cable? So they see the interest line item, the interest on the debt, and they say, oh my God, look at the projections. It is going to end up, we're going to end up spending more on interest than we do on the military. To which I say, we can always write different numbers in the military budget if that's your thing, right? I mean, there's nothing to prevent you from putting more dollars in education or infrastructure or anything else. You're Congress. You write the budget. You can put any numbers in any line item you want. Now, does that mean that interest expense is the best way to use public money? Is that, the most productive way to deploy federal dollars? I think probably not. And so I talk a little bit about that in the book. If we want to really talk about the interest expense, we could just recognize and remember that the bond sales themselves are voluntary. They're optional. You don't have to sell the treasuries in the first place. So if you don't like that line item in the budget, you could make a choice to stop selling treasuries. And over time, all the outstanding bonds would mature, and the line item called, interest on the federal debt in the CBO report would go away.
Now, let's take that point, right? Because it's wonderful. Everything logically follows, and you get to the next one and you go, well, hang on a minute. So all you ever hear is, well, hang on a minute, right? So let's do a well, hang on a minute. So yeah, you could totally do that, but would there be any bad consequences if we basically wound down the dollar debt market that the entire world seems to use?
Maybe. That's why I haven't advocated it, and I talk about it in the book, and I say, listen, what we could do, and I say this also in the book, is we could let the Fed issue the securities. We don't have to eliminate the option of holding duration and having some yield associated with that in a risk-free, dollar asset. So there are ways around that, but you're right. I mean, I say it as sort of a way to respond to people who just are terrified by the very idea of this thing. Well, if you don't like it, you don't.
Yeah, stop issuing the credits in the first place. No, absolutely. This is is this a fortuitous world, or have we been heading here for a while? In the following sense, you and I went to college and studied economics at a time when the thing that everyone worried about was inflation, and now there doesn't seem to be any. And the world that you describe in MMT is one, I think, that kind of has an assumption built into it somewhere that says that price stability is normal. Because if we had unstable prices, right, if you were in Argentina or something, it is, as you say in the book, harder to do this type of policy framework, right? So we're in a world in which inflation, you don't hit your inflation targets, interest rates have been falling for years. Everything seems to be a perfect good storm for doing MMT. And in a sense, we could almost say that we're already doing it. As you pointed out, we're just doing it through the bond market rather than explicitly doing it through the government's charge. In a sense, have you already won? Have you already won the argument, do you think?
First, I'll say, in terms of doing MMT, we've tried to provide a description, right, of the monetary system and government finance and the operations and just sort of how it all works. So I think we've been doing it in that sense for the whole entire time, a couple decades and plus of descriptive analysis. But I think what you probably mean is where we're making more ambitious use of the monetary system and running more ambitious fiscal policy, and that, there hasn't been punishing inflation as a consequence because we're in this environment where there's just been relative price stability globally. Yeah. I mean, God, you watch, you look at Japan and you think, how complex a phenomenon is inflation, and how poorly is it articulated and understood by economists and, textbook money and banking models that would have us believe that the central bank can just essentially turn the dial on inflation. And, you look at the Bank of Japan and you watch 3 decades of hard work trying to get, hit their own 2% inflation target. Yeah. We watch the US, watch the Fed do it for a decade. We watch the ECB try to do it. I mean, it's just, if it were that easy to start up inflation, surely somebody would have figured out the recipe.
Right. So, but that goes back directly into sort of MMT's analytic of the world, which is the only constraint is inflation. Now, one of the ones that I know that you don't like people saying, and you do not say this, is like, you can spend whatever you want, there are no limits, right? You do not say that. But the limit is an inflation limit. But if we live in a world in which inflation, as you say, and I say, is incredibly hard to come by, then that really does suggest that the constraints are far less than we think they are. So just walk us through, why is the limit to spending inflation, and what does that mean in a world in which there seems to be none and it's just disappeared?
Well, so, economists generally think about inflation in one of two broad categories. There's the kind of inflation that results from basically too much money chasing too few goods, where the problem is the too much money part. It's the aggregate demand outstripping the economy's capacity to produce more supply to keep up. So demand pull inflation. And then there's the kind that most countries have faced when inflation has become problematic. And that's the, cost push inflation. And so we recognize, of course, that inflation can happen for a lot of different reasons. With respect to running the government's budget more aggressively, if we're talking about tax cuts or increased spending, then the question we're asking is, does the economy have the ability to safely absorb that new spending that would give rise to? So we're thinking more along the lines of the demand pull kind of inflation, but not to say that we don't pay a lot of attention to the supply side factors, right? The cost push sort of stuff. So, you have to recognize that you can get headline inflation well before you reach what you and I would probably agree is full employment, because you get bottlenecks in certain industries because of market power, pricing power. All it takes is some, higher housing prices, healthcare costs, energy costs. Those are such important drivers of headline, core inflation or CPI that, and then how would you fight that? If you've got pharma pricing prescription drugs through the roof, and health insurance companies are raising premiums, and healthcare costs are fueling an increase in kind of headline CPI, I don't think the right policy response is for the Fed to hike interest rates to deal with that kind of inflationary pressure. And I don't think the right response is for fiscal policy to raise taxes or cut government spending. So you got something else that you have to think about.
So there's a consequence of this way of thinking, which builds on some stuff that other people have done. Thinking of Robin at the BIS and others. The whole thing about nonsense output gaps. That essentially we really, if you don't know where inflation is, and it's hard to measure and all the rest of it, and you can't really then say if we're at full employment or not. And the hunch that runs through the book, and again, and I agree with this, is we're nowhere near what we categorize as full employment. In a sense, partly because labour has so little pricing power in labour markets that you can have lots and lots of people employed in incredibly low and or stagnant wages for a very long period of time. And then as we average this out and try and calculate GDP and the output gap and all the rest of it, it looks like that's full employment. But basically what you're saying in the book is we've got a long way to go before we get to that, before we really hit those capacity constraints. Do you think is that a fair representation?
I mean, in the moment, right here as we sit in June, whatever the date is, I think, yes, we had a long way to go before we hit capacity constraints. But even in more normal times, economists are starting to do better work around this. There are a few Italian economists who, in terms of where is the potential, where are the limits, right? We have to do better at modeling. And, in the 40s and in the 50s, people worked really hard to get a sense, not just at the aggregate level of the capacity constraint, but also within industry so that they could better plan. Can we do more infrastructure investment? Could we do more of this type of thing or that? Where are the pressure points and how close are we to them? But the other thing is, and I think this is important, probably I don't play it up enough in the book, is that there are things we can do to actually raise the roof, if you like, to lift those capacity limits. And so if we're investing in things like R&D and education and infrastructure, we know that enhances long-term productivity and increases future potential growth so that we can actually essentially create more space to grow into as we spend. So yeah, it's impossible. I wish we could take out the binoculars and see where the limits on the horizon are and perfectly, anticipate and respect those. We can do, I think, a much better job in terms of the modeling, but we will always have certain limitations.
So let's move it a little bit on there then to the central policy proposal, which MMT puts forward, building on Minsky and others, is the whole notion of a jobs guarantee. So first of all, please walk us through why that's the main thing and what you think it will do. But then I want to start bringing the politics into this. It's in the following sense. I've lived in the United States for 30 years. And the one thing that the Republicans and their allies are really good at is reverse marketing. So basically, they can take any good idea and make you convince it's the most stupid idea they've ever heard, right? So when you say jobs guarantee to individualist, rugged Americans, this combines all of the money for nothing, welfareism, big government, etc., right? But that's not what it's about at all. So sell me the job guarantee as if I was hearing it for the first time. Why is this a good idea? And why should we call it that? Why is that important?
Well, I'm not sure it's that important. I like calling it a guarantee, but there is a certain marketing, and you do have to win over enough folks whom that word is problematic. So, Randy and Pavlina and others and we've written and called it public service employment program, or, I don't know.
Public option,
differently. I think the purpose of the word guarantee is to make it clear that anyone who wants a job and can't find one anywhere else in the economy can have one. That it's not a maybe you can have one. It's not a, well, we'll work on it and see what we can do. It's you have an essential right to a job. So, when you mentioned Minsky, and Minsky saw the economy as inherently unstable, right? That over time it evolves, and through the evolution of financial balance sheets, the situation, the stage is set for financial crisis. And we have this institution in the Federal Reserve that exists to serve as a lender of last resort. What he said was, there isn't an analogous institution on the fiscal side to deal with the real economy. So Minsky came up with the term employer of last resort to be the analog to the lender of last resort for the real economy. He was writing about this in the 1960s and putting this forward. And he articulated the reasons. He said, look, this would be a powerful automatic stabilizer. He even said it would work like a buffer stock, that you could mimic the way that the federal government stands ready to support prices in other industries, right? In agriculture and so forth. And he said, basically, the government can create a perfectly elastic demand curve for labor, right? That anybody who wants to come in and sell their labor but can't find an employer to buy that labor, the government can provide the work. And that this would impart greater stability to the entire system. So the economy would perform better. And that's good for all of us, he thought, right? So you have this program in place where when the economy gets weak, instead of employers firing workers and them going on unemployment, often staying unemployed for long periods of time where they become unemployable because their skills atrophy and so forth, they could transition instead immediately into new employment. And they could be put to work doing public service oriented jobs. And we've always said, the job should be oriented around caring for people, caring for the community, and caring for the planet. The program is federally funded, but locally administered. So people in the communities themselves, and I think this partly speaks to the concern of big government and the more conservative oriented, is that this isn't the federal government coming in and saying, these are the jobs that will be performed in this small town in northeastern Oklahoma because we know best what the needs of your people are. These are the people in a small northeastern town in Oklahoma saying, we value these things and we feel that there's a lack of this kind of work and contribution to the community. We would benefit from these sorts of jobs. So people get to transition into employment instead of becoming unemployed. Then they are more hireable, they're more employable, they can transition back as the economy recovers. You're putting a floor under incomes, right? So you're providing that support. There's no time limit with unemployment insurance. It runs out. And then Congress has to act again. Are we going to extend unemployment insurance? And then you have the vulnerabilities. Here, you can stay in the program until you're bid away from the program by some other employer at a small markup over the cost. So we think that, it's a way to get you to true full employment, where there's effectively no involuntary unemployment. Anybody who wants a job, can't find one, can have one at a living wage with some benefits, and it's a powerful automatic stabilizer. And it doesn't require an act of Congress. Only one time, right? You only have to have one act of Congress. Then you have the program, and then it's in place.
So I buy it. I mean, I look at it this way. Now, in some British, in European and Britain, etc., with wage guarantees, there's a kind of halfway house to this. But this is one that puts it in and says, look, if everything's going fine, it's like airbags in a car. You don't really need it. We think there's a lot more slack and there's a lot more jobs that could be done. We've already dealt with a financing constraint, right? We know that there is money to do it because we're not taxing in order to do it, right? That's not there. Your only other real constraint at that point then becomes the fact that some people may not like this. That is the old Kaleki's old warning, that essentially when you run real full employment for a sustained period of time, management loses the right to manage. More specifically, the incredible inequalities that we've allowed to generate in the economy over the past 30 years. This would take a huge chunk out of that. And therefore, you might find a whole alliance of people who will say, no, we really can't do that. We absolutely really can't do it, because people like me will no longer have the exorbitant benefits and exorbitant share of things that I have. So do you think it's politically vulnerable, even if it makes perfect sense in terms of a macroeconomic stopper?
Sure. Look, it's a public option. And by definition, it exists as an alternative to what the private sector is offering. In the same way that a public option in banking or a public option in healthcare or anything else we might imagine creates an alternative way for people to either spend their time or their resources, right? And so it is going to be perceived as an unwanted threat by those that benefit from the existing set of arrangements. No question about it.
The interesting thing, again, just think about the fiscal response just now in the United States. So the CARES Act and associated pieces of legislation cost $3 trillion, right? Just call it what it is, $2 trillion. Now, if you just had a jobs guarantee in place to absorb all of the additional labor, it wouldn't have cost anywhere near $3 trillion. It's the same logic as QE. I mean, just do helicopter money. It's so much cheaper rather than trying to boost asset prices and some of it trickles down. So again, I'm saying this because, again, I agree, and I just think of all of the things you could have a public option on. Healthcare, you mentioned, employment, etc. It's really telling that this society in particular doesn't have those things. That this is ultimately a political problem rather than an economic problem.
Yeah, I mean, look, I don't know what will happen in the years ahead. I think that having millions and millions of people, tens of millions of people now unemployed, and if they remain unemployed for the long term, we don't know what's going to happen with this virus. We don't know what the snapback's going to be like. But there is a real possibility, I think, that we're looking at through the fall and into the early part of next year, easily in unemployment rates that stay in the double-digit territory, that you got tens of millions of people. Your unemployment insurance runs out. And then what? Yeah. Then you got a bunch of people who say, oh, well, we'll invest in training for the unemployed. Well, what's the point of training people for jobs that don't exist?
Yes, you need to supply the jobs, right?
Look,
absolutely.
You got people like Mark Cuban and Ray Dalio, and these guys are out there talking about pitchforks and social unrest and recognizing, Mark Cuban said, you got to put people to work. You can't have tens of millions. These young people have a lot of energy and time on their hands. And, if there's no opportunity, they're going to let you know. You're going to hear from them. And I think that maybe, that is a kind of backdrop against which politicians might develop an appetite for something like, whether it's pilot programs for a job guarantee or something. You're going to have to do something to directly employ people.
Mm-hmm. And of course, in the US, that's complicated, as you mentioned earlier, by the fact that states, which if we think about California are bigger than some European economies, are not monetarily sovereign. So they themselves have these enormous constraints. So it has to be the feds that come in and do this, even if they don't tell you which jobs to have. It's got to happen at that level. It can't be a state level, right?
States are already massively laying off public sector workers. And you know that they did this after the financial crisis when their budgets started hemorrhaging. And so you had, an enormous number of people lose jobs in the private sector as a result of state and local governments shedding workers. And it was only in the last 3 years or so that we really clawed back at the state level many of those public sector jobs. And now here we are again. We've already lost over 1 million. Goldman Sachs says if Congress doesn't come through with aid to help states out, that we could see another 1.5 million public sector jobs at the state and local level disappear in the months ahead. So they're not going to be the ones to step up. We need them first to re-employ people that they've already laid off. And then we're going to need a lot of uptick in, hiring as well.
So one question in closing, another policy, or it's bigger than a policy. I mean, I think of things like this is as part of the furniture. Like if you put in place a federal jobs guarantee, it changes a lot of other things, right? It's not just a standalone little checklist policy. It changes the way your economy works. The other alternative that people are fond of is UBI, right? So how do you see the relationship between the two? Do you see them as alternatives? Are they complements? How do you think about these two things hanging together, or are they different from each other?
Basically, I think the question is, what problem are we trying to solve?
Right.
What problem are we? So with respect to the job guarantee, we're trying to address the problem of unemployment, people who want work but can't find it. So a UBI doesn't address that. The job guarantee addresses that. If the problem is, how do we keep people in this moment, where we are today, from not being able to buy food, from not being able to pay their rent, from not being able to stay current on other recurring bills when they can't go out. We can't have people safely go out and work. Then I think, making cash disbursements to people, I'm enthusiastic about doing that. There are considerations in a regularly operating a normal economy where if you're sending truly universal payments, right, it's supposed to be enough to allow you to opt out of the labor market, because I don't like the man and he's got his boot on me and I want to be able to walk away from my employer. So some people pitch UBI as it should provide enough income so that someone could just disengage from the labor market. If they don't want to work, they shouldn't have to work. They should just have enough income to subsist on, right? And pay your rent, buy your food and entertainment and whatever else. So you're talking, $30,000 a person. You hear numbers like that. Maybe kids get half. There are different proposals. I think at that point, you have to ask the question, that's like 40% of US GDP. What are we thinking about inflation risk at that point?
Whereas if they were actually building productive assets that would then lead to future growth, a kind of a Caldor effect that would pull out of this, that would give you the headroom for doing it.
Yeah, but you have, so that's exactly right. You have to think about, I think, the inflation risk associated with a very large scale, truly generous, truly, basic income, enough to subsist on. I guess I'm more personally sympathetic to sort of Martin Luther King Jr.'s call for jobs and income support for those who either cannot or should not work. And we can define should not pretty broadly. We could say maybe somebody who's got a child or is caring for an elderly person falls in the should not work category. So you give them an income so that they can, care for somebody else. So I think they can work alongside one another. There's not an inherent tension between them.
But the one thing we do know is there is one problem that isn't out there, and that is that the government doesn't have any money.
We could definitely fund a job guarantee and provide some basic income support.
Yes, exactly. So I'll close with a story. Years and years ago, before I'd ever heard of MMT, I just started sort of giving talks around the theme of austerity. I mean, I'd heard of it, but I hadn't really sort of, investigated, etc. And someone stood up at this talk, and it was an older gentleman. It was out at Wellesley. It was a public talk. And he said, "Can you give me an example of any government that's ever lived within its means?" And I said, but it's a bit weird of thinking it that way, because in a sense, what their means are is the thing that they print, that then you spend your whole year gathering as taxes to pay back to them. Why would they ever run out of the means that they themselves issue? And the guy at the back of the room, to his credit, went, "I don't know why I've never thought of that before." And he sat down. So there's something incredibly arresting in these ideas. And I think that people are that close to accepting it, but there's just something about the socialization that we've been through that, no, that can't be true, that stops us making the next step.
Yeah, I think that people are reluctant to buy the idea that there's a free lunch. And that's not what it's about, right? It isn't that there's a free lunch. It's that when you say live within your means, we do have to live within our material and ecological means, right? And so it's just about deciding how many of our national resources do we think should be devoted to producing public goods, and how many should be left to the private sector to use in ways that they choose. You know, if you want a guy standing on a corner spinning a sandwich thing saying $3.99 pizza or whatever, that's somebody's time being used by the private sector. They're compensating that guy. Maybe he could be employed in ways that are more, I don't know, socially useful, that make a different and more high value contribution to his community. I don't know. But I do know that when there are idle resources, unemployed people, that the government can very easily scoop them up and put them to use, put them to work doing something that is productive and socially useful. And I think all of us could find interesting, important ways to employ people that enhance the well-being of society as a whole.
Absolutely. As you say, our infrastructure went from a C to a D+. It doesn't get much lower than that, and there's 2 trillion of it waiting for a refit. Great conversation. I recommend this as a game changer for everyone. You got to read it. This is the one economics book you should be reading this summer. Go get a copy, go read it, go engage. Thank you very much, Stephanie Kelton.
Thanks, Mark.
This episode of the Rhodes Centre podcast was produced by Dan Richards. You can subscribe to us on iTunes, Stitcher, or your favourite podcast app. If you like us, rate us on iTunes and help others find the podcast as well. For more information, go to watson.brown.edu/Rhodes. Thanks for listening.